Hello and welcome. You are watching All About Your Company here on ET Now. I'm Harsh Saita. And as we typically do, how Warren and Charlie typically advises the retail investor, you must know about your company, about the companies you invest in, and only thereafter should you invest. This show is focused on giving you exactly that. Powerful insights, clear views, and exactly a lowdown on what the business is all about. And only then should you decide whether to invest or not. And that's the key crux of this show. Let me first give you a lowdown on what we will be discussing today. We will be talking about Northern Arc Capital, which is an NBFC. And we will first take you through what the business is all about. Thereafter, we will take you through the 3 years journey of the company. And last off, we will speak with the management of the company. We will be joined in by Ashish Mehrotra, who's the managing director of the company. Now, let's first start by speaking about the key discussion points that we have with regard to Northern Arc Capital. First off, we've seen a rise in the credit cost. That credit cost had certain one-offs as well, but has the credit cost now truly stabilized? That's really the first question we'll be putting across to the NBFC. And mind you, credit cost is a big problem currently in the MSME, MFI industry, which is what Northern Arc deals with. The MSME as well as MFI guardrails, are they fully compliant? Is the full impact of that already built into the Northern Arc Capital balance sheet is what we'll try to understand better. Third piece, what's the risk on the books? What should the credit cost guidance be going forward? Can we expect a stable credit cost number? And what will, therefore, the financial parameters be as we go ahead? The CEO's take on the business model itself. It's a very unique business model, viewers. You want to understand the business model better. And of course, I will try my best to put it across, but we will have the CEO's take on it as well. We'll try and get a pulse of how he sees the evolution of the business model. The turnaround with regard to OPEX, but more importantly with regard to profitability. This is a 3% plus ROA business. ROA, of course, is one of the metrics of profitability. It's a 3% ROA business come off to 2.5%. Therefore, can we turn that around back to the 3% number is what we'll want to understand. And levers for ROA upside. What are those levers outside of credit cost that the management can use to ensure that there is ROA upside from here? By the way, the ROA guidance from the 2.5% currently, or sub 2.5%, is 3.7 to 3.8% by FY28. So it's going to be a significant ROA uptick if all of that were to actually play out. I'll be very curious to know what those levers are that they're going to use to ensure that that ROA inches up. Also, the company fascinatingly listed at 263 rupees a piece, or rather, the IPO price was 263 rupees a piece. Currently, the stock is at 260 rupees. So we've seen 1 year where you've not seen very good returns for investors who are holders for the last 1 year. What's in store for the next 3? That's what you really want to know if you're an investor and invested in a Northern Arc Capital. Also, if you see from the bottom of, and if we can pull up the financial year-to-date chart, the financial year-to-date performance of this company is 55%. So we've seen a turnaround already at play where the company is concerned. Can that continue? Can that continue to ramp up? Because it's not particularly expensive in comparison to some of the other counters. And look at valuations as well. But let's first start off with all about the company, what you need to know. It was founded in 2009, and it was founded with the intention to facilitate credit for underserved segments. How did they do it? One, of course, currently they do direct lending, but earlier they were in the credit solutions business, and we'll talk about that in just a bit. Currently, in terms of the lending, it's fairly diversified. It's MSME, consumer, rural finance. They cover all 3 aspects, and it leverages on proprietary platforms for lending. They have their own technology stack on the basis of which they lend. Further, they lend through 372 branches, and they have tie-ups with nearly 350 plus origination partners, which are other NBFCs and platform companies, which utilize their tech to ensure that lending is happening in a seamless manner. Now let's talk about the initial phase, and this is important to understand because it gives you entire journey of the company. 2009 to 2017, it was a credit solutions company. It was it used to partner with certain other originators, NBFCs, platform companies, and it used to give its customers, which is these platforms and the NBFCs, structured deals. They used to securitize some of the debt which these companies used to take on, or they used to lend, and they used to assign some of these debts. In fact, it's still one of the largest, or one of the largest has a very, very strong market share in the securitization business in India. The second is the transition phase from 2018 all the way to 2022. When they started to lend, they leveraged on the data available to them from their partners, which they were helping with regard to securitization and other services. They leveraged on that data to start lending from their balance sheet. That's what they started doing. And they started entering the lending space. They thereafter expanded to the MSME space from the consumer finance space, which they entered in 2018. And thereafter, now the direct lending is actually 54 to 55% of their overall AUM. So it's gone up substantially from the 20% mark in 2022-23 to now sitting at 54%. So the ramp up has been very, very sharp. And they listed in September of 2024. The current AUM of the company stands at roughly 14,000 crore odd. Now, what's unique, right? Every company needs to have something unique. Now, here, the unique proposition is the retail lending and credit solutions that the company does. It's a combination of lending plus credit intermediation services. I'll try and break this down into slightly more simpler terms. Basically, they're enabling NBFCs to lend correctly and fairly basis certain tech stacks which they have built. And let me take you through the tech stacks and the tech infrastructure as well, because that's unique. Nimbus, it's a workflow system for debt placement and lending. NPOS, it's a digital co-lending and loan origination platform. So that's the in-house loan origination platform they have. NewScore, that's a machine learning scorecard for retail underwriting that they have. And Altify, which is the platform for retail investors to access debt products. So you can actually buy debt products off that platform. The products which they currently do is MSME lending, consumer lending, rural and microfinance lending, credit solutions, which we spoke about. They also do debt placement services. So all of those are what they do in terms of products. Now, in terms of what else do, they do fund management, which is AIF and PMS. They have their own funds as well, through which they are able to leverage and provide NBFCs and lend through those PMSs and AIFs, leveraging on the tech stack that they have. They manage 12 debt AIF funds and 3 PMS schemes. That is obviously as of date. And they're currently managing assets of around 3,200 crore through these schemes, 3,200 crore plus. And new funds in the pipeline continue to play out over the next financial year as well. So this is all about Northern Arc in terms of the business itself. Now let's talk about some of the financial metrics that you must know if you're an investor. Let's start with the P&L account. Let's break it down. Let's analyze it. In terms of the last 3 years, the way the P&L has shaped up, you look at FY 23, 24, 25, the net interest income, which is the NII number, has gone up quite substantially. It's more than doubled. In fact, the 3-year CAGR on the NII is 50%, 50. But that's not the most important metric to look at where a Northern Arc Capital is concerned. You want to look at operating profit, because the fee income, if you've understood the business right, the fee income is also where some of the money comes from. And therefore, operating profit is the better metric to look at. And that has grown at 41% CAGR over the last 3 years. So that's seen a very sharp uptick as well. So very, very solid growth on the operating profit count. Then you have the key metric of provisioning. Now here is where it starts to get tricky. You've seen provisioning go up quite substantially. So you'll see the provisioning was largely flat over FY 22. It was at 37 crore. 39 crore in FY 23. FY 24 we saw a spike, 122 crore. And thereafter, FY 25, it was at 405 crore. Now, various reasons for that. We will take you through those reasons. But most importantly, that number is expected to come off going forward. It's expected to improve. And it was impacted by one-offs. to put it very simply. So what we will see is the credit cost, which is the provisioning number, will start to come off. The peak has already happened, and there were certain default loss guarantees which needed to be provided for in FY25, especially in Q4, where they did 200 crore of provisioning. That will likely go away. So what we will start to see is credit cost aiding profitability. So if you see the profitability number, can we pull that up, please? It's gone up, but FY24 and FY25, it's been flat, 308 and 305 crore. And therefore, what we have seen is no significant inch up there. But credit cost will support that going forward very, very likely, and therefore ROAs will inch up as well. Now, that's the picture, of course, with regard to the P&L account. And we're starting to see some bits of improvement starting Q2 FY26. So we want to wait it out and see what the outlook for the rest of FY26 and beyond is. Take care of this, because the P&L is going to play a huge role in the way in which ROA shapes up. So you want to take care of that point. Now let's talk about the balance sheet, and you see the way in which AUM has moved. The AUM has gone up from 7,000 crore odd to 14,000 crore. So you've seen a significant inch up where the AUM number is concerned. And what we've seen is that's grown at a 22% CAGR over the last 3 years. You look at disbursements as well, fairly healthy inch up. It's nearly at 20,000 crore at the end of FY25. And capital adequacy stands at a very healthy 24.6%. Do they have more tailwind for growth? Surely. So therefore, what you want to wait and watch out for is whether that tailwind for growth can continue at the same clip at which they've been growing. Obviously, a positive with regard to the way the balance sheet has shaped up till date. Let's talk about operational metrics now. The yields on advances, and in terms of the yield, it ranges between 16 to 17% currently. And as they continue to grow, that yield has inched up because they are able to absorb higher risk. The second is your cost of funds. Now, cost of funds have inched downwards, and therefore you are getting support on the margin count. You look at the 8.55% cost of funds in FY22, currently sits at 8.7, but your repo has gone up substantially from that point. And therefore, I would look at this more positively than negatively. Despite the sharp inch up in repo, we've not seen the cost of funds go up in proportionate terms. The margins are now from 5.5%, now sit at 9.3%. Those twin levers are playing out on the margin number. Let's look at cost to income. Cost to income has been around 35 to 45%. Currently, it's at around 37.6%. So it's below the 40% mark. But there was a period of time in the middle where they were investing to try and grow their direct to lending business. And that's where your cost to income rose. Your credit cost number traditionally has been very, very subdued. It's been sub 0.7% for a very long period of time. Thereafter, we've seen an inch because they started doing direct lending, and therefore we've seen an inch up in credit cost. For FY25, it was at 3.2%, which was 70 bips above the guided range of around 2.5%. Currently, it's falling. It's on a falling trajectory. It's at 2.7% currently. Last off is the ROA number, which is likely the most important number you want to look at. Across cycles, you have to judge whether the company can continue to do the ROA that they've traditionally done. And they have done that despite the challenges on the credit cost count. So you're seeing an ROA of 2.6% currently, and we've seen an ROA of nearly 3% in FY24. So you've started to see an inch down because of the credit cost inching up, but likely that unwind on credit cost should aid the ROA number going forward. And we'll get a perspective if that will actually happen or not. You look at the gross NPA number, traditionally been below 1%, but we've seen an inch up in the gross NPA. This is not looking too good, right? So your asset quality has become slightly unfavorable. You want to wait and watch as to what plays out here. Traditionally, it's a sub 1% gross NPA, which is very impressive, but this is extremely subjective, right? We've given this a neutral, but that's largely because of the fact that you've seen an inch up in the gross NPA. And your gross NPA inching above 1% was not what was penciled in, and therefore we've given this a neutral. Want to wait and watch for this. Net NPA, very similar. If you have a look at those metrics, you've seen an inch up. Now, where does it go is really the question, and what to expect going forward on the book is the question. ROE. Now, this is a key metric that one looks at. In terms of how one looks at the ROE, you look at it 15% was the top in FY24. Thereafter, it's been largely just about double digit. So what you want to see is whether there's an inch up in ROE, and if so, how quickly will it inch up is really the question. So we'll wait and watch out as to how this plays out and what the commentary suggests on this number. But currently at 10%, it's at best a neutral. Let's look at shareholding now, and this is again where things get very, very interesting. Two very interesting investors feature in the shareholding pattern of this company. One is an Ashish Kacholia, a big investor, owns 2% stake. He bought it at 170 rupees a piece. And second one is Madhusudan Kela. He also owns a stake in the company at 208 rupees a piece. Now, currently it's sitting at 250 rupees. So you want to wait and watch out for that. But these are the number of investors. The number of investors haven't gone up substantially, right? And that's another key positive. Now, let's look at valuations. And you look at the book value, which is at the end of Q2 FY26 is at 227 rupees a piece. You look at market price, which is 263 rupees a piece. And therefore, what you typically get to understand is it's trading at around 1.2 times price to book. The EPS is around 19 rupees FY25. Now, mind you, FY25 was a tough year for the company. So EPS likely to inch up for sure. The price to book during listing, and they got a decent amount of interest during listing, 1.5 times. And therefore, could you see a re-rating? You could well see it if this plays out well. In terms of the brokerage call, 2 buy calls, no holds, no sells, just 2. ICICI Securities and DAM Capital actually have a rating on this counter. We've given this a neutral just because there isn't enough coverage for us to firm up a view. But two analysts track it nonetheless, and which is a positive. And in terms of the way in which the stock returns have been, 2025 so far, it's been an 18% return for the company, 55% in FY26 so far. Okay, now let's last off look at the return potential. It's 36% as per the 2 analysts who track it. That's the average return potential of this company. What you want to try and circle back on is try and understand that overall you don't have any of the metrics that we've analyzed don't look tough, other than the fact that the credit cost needs to see a bit of turnaround. So if you notice the kind of things that we really want to really identify within this company and understand, it's the fact that whether the credit cost turns around or not, and we will analyze that. On the other side of this break, we will have the management come and speak with us. We will have Ashish Mehrotra on the other side of this break to talk to us about exactly this. Stay tuned, viewers. Welcome back. I have the pleasure of having with me Mr. Ashish Mehrotra, the Managing Director and CEO at Northern Arc Capital, to talk to us about all that we've analyzed. Ashish, let me start off. This ROA inch up towards 3.7, 3.8%. What are the levers available to you to get there?
Hey, hi, good afternoon. Happy to be here. Just quickly, I want to say something as I run through what you said earlier. We have 2 unique levers. One is the very powerful fee franchise we've been running for 15 years, which includes our asset management business, the fund management business, performing credit, and the placement business. That contributes about 25 to 27% of profits if you look at it. But on the ROA tree, it's about 80 basis points. As the direct-to-customer business grow, our NIM have improved from 5.6% to about 9.1% if you look at it in H1. And we see that expanding further as we continue to build the retail franchise and continue to build the power of the credit solution business. So you see expansion in NIM from 9.9% to 9.1 to about 11 over the next 2 years. And then you see build out of the fee franchise, which from 70, 80 basis point to about 110 and 120 basis point, which is purely on account of growth in the funds business and the placement business, which we run, plus monetization, some data and tech. That means you get to a loaded NIM of close to 11.5 and 12%, which gets you to an ROA, assuming that the credit cost stabilizes, and our stuff is about 2.6 to 2.7, and OPEX is now already down from 40% to about 37%, if you put it in that piece, at stabilizing at about 3.6 to 3.7. That gets you to a NIM, to the return on assets of about 3.7 to 3.8 over the next 2 years.
Brilliant. You've summarized very well. I'm short on time, so I won't coax on any of those points. Give us a sense of where this goes in terms of business model. Do you continue to scale your on-book lending, and what kind of growth should we expect on that?
So the way to look at it are, we on the two lines of businesses, the credit solution is a volume business where we enable the flow of money, and that creates a powerful fee franchise and continues to support it from balance sheet. Our direct lending business to customers is actually growing at about 50% plus, because we started building from a very small base about 5 years ago. Our sense is overall growth, if you look at this year, we should end close to 22 to 25%, but in the following year, in a normalized environment, we will grow close to 27 to 30%. And that means you will see the corresponding expansion in the NIM, or the net interest margin, coupled with the fee growth, getting you the right set of returns. We've chosen sectors where we focused on direct to customer business, which is the MSME, large part underbanked, predominantly secured lending for us, followed by the consumer, given that we are largely a consumption-led economy, and saying how do we enable convenience financing solution, and leveraging on our capability, understanding of rural, using our scorecards to underwrite, to build that back. I think that gives you both powerful expansion in the net interest income and about 25 to 30% growth on balance sheet on a year.
Excellent. Right. Ashish, on the credit cost, let's talk a little bit more near term. We've spoken about the next 2-year journey. Talk to us about how quickly do credit costs come off? What has the concern been? And how quickly do we start seeing that reflect on your ROA?
So if you look at it, actually last fiscal year, we ended the credit cost at about 3.1% or 3.2%. And that included 50 basis point of one-time adjustment we made because of the change in the regulatory interpretation of the digital lending guidelines, which is whereby you used to take advantage of the FLDG, which you had as in your provisioning cost. So that was about 50 basis point. If we correct for that, my actual credit cost is about 2.7, even in an environment which what you're calling out as a little bit of a stress environment. And slightly elevated credit costs came in on about 70 to 80 basis point, came in on account of MFI book of ours. To my mind, we've already seen that drop from 3.2 to now 2.7 in last quarter. I think we should end the year at about 2.5 to 2.7, and that's going to be, as our retail mix continue to improve, we will hover at about 2.3 to 2.6% credit cost range. But you will see a corresponding massive growth in the net interest margin because of the change in the mix.
Point taken. Ashish, in fact, unfortunately, that's all the time we have on the show today, but thank you so much for coming in and giving us that perspective. Well, if the ROA does go to 3.7, 3.8, which is what you're guiding for, that will likely see very strong tailwind in terms of operational as well as growth performance, which will likely play out over the next 2 years. That's how the stock is doing today. But with that, viewers, completely out of time on this debut show of All About Your Company. Thanks so much for watching. And from the team here, it's a goodbye.